Hey there, it's Mike Wise, CMG Home Loans, with your weekly mortgage update and exciting news this week. We have increased our loan limits for the Fannie Mae Freddie Mac loans to $802,650. So this is a little bit earlier than anticipated, but the old number was $766,550. It's now up to $802,650. So we can now do conforming loans up to $802,000, which is absolute crazy. This is not the actual amount that Fannie and Freddie or FHFA has actually put in place as of yet, but we're anticipating this change to be coming very soon, and we are starting to close loans at those levels with the lower rates on the $802,650. So great update there for us, and CMG is kind of leading the pack there. Also, wanted to give you an idea of inflation this week. Inflation is, the Fed really thinks that it's under control at this point in time. And today or Friday, the personal consumption expenditure, or the PCE, came out. And basically the headline number month over month was 0.091%. And year over year, it went to 2.2% from 2.5%. So the year over year number is coming down. The core number went from 2.68 to 2.68 from 2.64. So what's kind of the run rate here of the PCE, the numbers month over month? So basically, if you take the 4-month run rate of them, that means counting just the last 4 months and averaging them, you're looking at 1.77%, so which is well below the 2.2% that the Fed is looking at, and the 6-month run rate is at 2.37. So clearly, we are headed in the right direction. But take a look at the replacements over here on the right-hand side, and you can see that we replaced 0.319. So basically, this is a 12-month run rate, these replacements. So what they do is they measure the PCE over 12 months period of time, and every time they move down a month, they actually take out the previous year's number. And so September, they took out the 0.319 number, and that was the core, and it came in at 0.13. So we're replacing a higher number with a lower number. Well, the next 3 months, October, November, December, of 2023, are replacing those really, really low numbers. So we don't think that we're going to see any improvement in the inflation over the next 3 months. But starting in January, that's when you're going to start to see some of the numbers come down, because we're replacing these higher numbers of 0.498, 0.239, and 0.339 in the first quarter of 2025, and replacing those numbers from 2024. So we're headed in the right direction. But as far as inflation is concerned, we're not going to see any improvement for the next 3 months. Now, shelter is a big part of the inflation numbers. In the PCE, it's about 19% of the numbers here. And you can see that it is a lagging indicator, the shelter. And so we're going to start replacing some higher numbers on that as well. And so that's going to make a significant impact on inflation going forward as well. So what I'm trying to say here is inflation is coming down. The big thing that you got to be looking at is the employment numbers for lower mortgage rates. So the more unemployed, the higher the unemployment rate is, the lower the rates are going to be. So this week, the yield, it basically traded sideways. The rates did jump up a little bit. I'll show you that in just a second. But you can see here that we've been running right around the 101.52 on the treasuries. That's the pricing on the treasuries. The higher the prices, the lower the rates are going to be. And so you can see that the pricing has come off of that. We're hovering right around 101.22 as of this morning, which is right on this 25-day moving average number here. So it's kind of bouncing off that 25-day moving average. And then if you go down to the yield, We actually went up. We hit 3.8 on the yield, and it's come back down. And basically, as of last Friday to this Friday, we're really at 3.75. But you can see from the lows down in the 360 level, we're up about 15 basis points, which again has a negative impact on rates. Last week we were at 6.17. This week we're up at 6.21% on a regular 30-year fixed rate mortgage. The jumbos right around the same, 640 is the number there. So interest rates, they're up slightly, and we'll hopefully see some lower rates. I don't think they're going to go down too much here very fast. So maybe later in the next couple of months, we'll see some lower interest rates. On real estate, this is kind of Case-Shiller came out with their numbers year to date. They're at 2.2% for 2024. And you can see over the last 4 years here what they've done. Up 10.6, up 19%, up 5.7, 5.7. So we're kind of on the same trend for about 5%. And if you look at the national average, well, it's right at 5% here. If you're in LA, then you're talking about almost a little over 7.25%. New York City is doing a lot better. Las Vegas is doing a lot better. And then you have some of the other cities over on the other side, Portland, Denver, Dallas, Minnesota. Those are all kind of lagging behind there at the lower levels. But in any event, real estate, a good investment. If you could do 5% every year, in 5 years, you're up 25% on your house. So real estate is a good investment. Rates, again, just to give you a comparison, we're up 6.23. The recent low was 6.11, and we're down from a year ago at 7.5%. So trending in the right way. I do have the special program here where I give you the first year at a lower rate, at a bought down interest rate at no cost to you. It's a lender paid buy down. So call me to learn more about this program. And if you have any questions, I'd love to talk to you about it. This is Mike Wise. I will be around this weekend. If you have any questions, please feel free to give me a call or shoot me a text, and I'd love to hear from you. See you next week.